Hello everyone. In this video, let's talk about financial ratios. Now, what are financial ratios? These are the ratios which are used to evaluate the current financial performance of a company, to evaluate the future or potential problems, and also to take major decisions of the company. Now, let's look at the top 10 ratios which most of the businesses use to take these decisions. The first one is current ratio and quick ratio. Now, why am I using these two in combination is because these two fall under the major ratio kind, that is liquidity ratio. Now, what are liquidity ratios? These ratios evaluate the financial health of a business. Let's look at current ratio first. The formula is current assets divided by current liability. The ideal ratio is 2 is to 1. Now, what does this mean? Suppose a company is having total current liabilities of 10 lakhs and total current assets is 20 lakhs. Now, that is an ideal ratio. Why? Because the current assets are double the amount of whatever current liabilities it is having. Now, why is this ideal? Because let's say if current asset has decreased to 15 lakh, now that means current liabilities will increase and it will not have any buffer amount or buffer cash to pay off the current liabilities. Now that's why 2 is to 1 is the ideal ratio any company should have. Now I have mentioned in the definition that this will also help in tackling the potential problems of the company. Now let's say in future current assets has decreased to 15 lakhs as I said, and current liabilities stand at 10 lakhs only. Now after comparing it with the ideal ratio, they get to know that the current ratio has reduced, and they will take suitable measures to increase it back to 20 lakhs so that they remain at a safer place. Second one is quick ratio. Now most of the businesses prefer quick ratio over and above current ratio. Why? Because we will look at the definition of quick assets. The formula is quick assets by quick liability. And what does quick asset mean? It means current assets minus stock minus prepaid expenses. Now why are we deducting stock and prepaid expenses? Because stock, it will be in the form of physical stock, and for the stock to get converted back to cash it will take more time, and also for prepaid expenses to get realized it will take more time. But if we are left with other current assets such as cash and marketable securities, we will have instant cash in hand, so we can be able to pay off the current liabilities immediately without any waiting period. Now that's why quick ratio is preferred more over and above current ratio. Let's look at the next ratio, that is inventory turnover ratio or stock turnover ratio. Now this is one of the ratios under turnover ratios. Now what does turnover ratios means? Turnover in other name is also called as sales. Now we will use sales to calculate all these turnover ratios such as asset turnover ratio, etc. Why? Because these turnover ratios will be in a relationship with the respective line item. We will get to know how many times that particular line item is being utilized properly in an organization. Now let's look at this stock turnover ratio. Formula is cost of goods sold or sales divided by average inventory. Now we should take cost of goods sold. Why? Because it is always expressed in cost terms. Now in the absence of cost of goods sold, we can also take sales, but mostly cost of goods sold is preferred. Now let's take an example. Cost of goods sold is 10 lakh rupees and average inventory is 2 lakh rupees. Now what is the ratio? We will get 5. Inventory turnover ratio or any other turnover ratios are expressed in times. That means 5 times. And this is higher the better. Why? Let's say 12 lakh. Cost of goods sold has increased to 12 lakh and average inventory is at 2 lakh constant. Now what is the ratio now? It has increased to 6 times. Now higher the better. Why? Because stock is getting converted back to cash more number of times in a year. So that means the movement is more compared to the previous ratio, which is 5 times. Let's talk about debt equity ratio. Now the formula is total debt divided by total equity. For this ratio as well, the ideal ratio is 2 is to 1. Now that means if a company is having 50 lakh rupees of equity, it should have at least 1 crore rupees in the form of debt. Now why is this ratio, the ideal ratio is 2 is to 1? This is because, let's say for example, company is having less debt, let's say 20 lakhs and equity is at 50 lakh. Now as we know that for equity, there is no compulsion or mandatory thing to pay any interest or dividend compulsorily, unlike preference shares. But for debt, there is a compulsion or there is a obligation for a company to pay interest monthly. Now, if debt is more, then company will be more cautious about their transactions, their decisions, because they will have to face the consequences if they take any wrong decision. So that's why total debt should be double the amount of total equity. Let's look at one more ratio similar to this, that is capital gearing ratio. Now what is the formula? Preference share capital plus debentures plus borrowed funds whole divided by equity share capital plus reserves and surplus minus losses. Now we can also write this formula in one more way, saying that fixed interest bearing securities divided by floating interest bearing securities. Now why am I saying this is, now these preference shares, debentures or any other borrowed funds, these are having fixed interest bearings on them, and equity shareholder or equity share capital does not have any fixed obligation. So this is similar to debt equity ratio, but this gives a more clearer picture, and what is the amount of each of preference shares, debentures and other borrowed funds in relation to equity. So most of the businesses use capital gearing ratio in place of debt equity ratio to take major decisions. The next ratio is ROCE, that is return on capital employed. What is the formula? EBIT, or earnings before interest and tax, divided by capital employed into 100. Now earnings before interest and tax we will arrive at after deducting all the direct expenses, all the indirect expenses, except for two fixed obligations, that is interest and tax, divided by the capital employed. Now this ratio suggests that how well the company is utilizing the capital in order to generate profits. If the ratio is higher, let's say some 20-25%, that means it is utilizing their capital very well to generate profits. If it is low, then they are not utilizing well and they can utilize more effectively to generate more profits. The next ratio is cost of goods sold percentage. Now this ratio is one of the basic ratios, like the formula is cost of goods sold divided by sales into 100. Let's say cost of goods sold is 10 lakh rupees and they are generating total sales of 25 lakhs into 100. What is the percentage? 40%. Now how can we interpret this ratio? 40% of the total revenue is cost of goods sold. That means in the remaining 60% they have other expenses, like direct expenses, direct labor and other indirect expenses, and also profit. Now 40% is cost of goods sold, the 60% comprises of all the other expenses and the profit. This ratio is also lower the better. Now why? Because if they are utilizing total sale or total expenses, less expenses to generate more sales, that means they can have a higher profit margin. And next ratio is net profit ratio. This is also one of the major parameters used by the shareholders to take decisions before investing in any stocks. The formula is net profit divided by sales into 100. Now how will we arrive at net profit? Net profit is also called as EBIT, the same as EBIT, divided by sales into 100. Now net profit we can arrive at after deducting all the direct and indirect expenses, and net profit ratio is also higher the better. Next one, let's look at PE ratio. Now this is one of the unique ratios also used by all the investors to take decision before investing in the shares. Now the formula is MPS, or market price per share, divided by EPS, or earnings per share. Now market price per share keeps on fluctuating as compared to its face value, and also earnings per share is also it also keeps on changing depending on the total earnings and number of shares. Now this ratio is also one of the major parameters used by the investors, also the business. Let's look at the last ratio, that is earnings per share. The formula is net profit available to equity shareholders. Now what is this amount? This is the amount a company will arrive at after deducting each and every expenses, direct expenses, indirect expenses, all the fixed obligations, and after paying the preference shareholders, they will be left with some amount which will be distributed to equity shareholders, divided by the total number of equity shares which is outstanding in the market. Now EPS, obviously it is higher the better. That means you are able to generate this much amount of money for every share you have. So that means it will influence or motivate people to invest in more number of shares. So we have looked at all the top ratios which are used by either the company or the investors to take major decisions. Hope this video helped you. Thank you.
If you like this video, please do share, like and subscribe and reach us through comment section. Thank you.